Well, welcome everybody. Hope you had a fulfilling lunch, and if I see anyone who's sleeping, we got some water up here we can just sprinkle in around. We've got a packed agenda for the after-lunch session, so I'd like to do a brief introduction for our panelists and then have them use their time appropriately. The format is, each presenter is going to present on their topic, followed by 10 minutes of Q&A, and at the end of the three presentations, we'll try to weave a theme and have any questions that you submit on your app, and I'll try and ask the panelists to answer appropriately for their questions. So this is a very international panel. I think of all the meetings we've been in, the most international. My name is Adam Rees. From my accent, you might detect that I was born in England, but I live in the United States. And I'm the executive director of the International Association of Consulting Actuaries. And also sitting on that board is Abe. Abe is the he actually sits on the IAA Strategic Planning Committee and Nominating Committee. He's a member of PBSS and IACA and is the president of Vitalis. Abe will be followed by Masaki. Masaki is from Japan. And then following his presentation, Ramon, Armando, and Natividad from Spain. So actually, I forgot to mention that Abe is from Portugal. So we have US, UK, and Mexico. Japan, Spain, and Portugal. So without further ado, Abe, you're up first on the probability of ruin approach to optimize pension fund investments. The floor is yours.
Thank you very much, Adam. Thank you very much for all of you being here. Good day. And okay, I will present this. This is a presentation of the thesis I'm working on as a PhD student at the University of Lisbon, along with Professors Agnieszka Bergal and Alfredo Egidio de Reis. It's okay. First, a bit on the motivation of what I'm doing. I mean, I have been working for pensions and investments for more than 30 years now. And I mean, the pension funds and other retirement assets add to around 40 trillion US dollars, give or take, which is almost half of global GDP. So we're talking about great amounts of money. And variation in asset values is arguably the most significant component of the determination of the probability of ruin of a pension plan, and of a pension plan not being successful. I mean, changes in interest rates and other economic variables affect both liabilities and assets in different ways. So this establishes a complex dynamic. And what we care about usually is about what we call the funding ratio. I mean, so the funding ratio will tell us if the assets are enough to cover the liabilities. So ILM techniques are usually used to approach these systems, and there are some results for solving this on a nice formula, but they are usually models that are not very realistic. So I have gone through doing simulations to approach this. I'm using some basis of what we know as probability of ruin, which is usually used in non-life insurance to determine some kind of solvency of a company, or in fact the probability of ruin. So I'm taking some concepts, not exactly the same definitions, in order to approach and to get an optimum portfolio in terms of our ruin probability. I have been doing some work since 2015, along with Jonathan Salgado, and I presented a brief paper on this in the PBSS and Life Colloquium in Oslo in 2015. So we're talking about a defined benefit pension plan. I mean, this is just as an idea. It's a plan that will give a pension equivalent to 1% of salary times the years of service. So any familiar with pension plans get this kind of plan. And here, we compute the actuarial present value, the actuarial present value of salaries, the defined benefit obligation, which this one is very important for accounting purposes. And it's usually what will tell third parties about the funding ratio. Other measures have more to do with for funding purposes, but for accounting, the DBO is what is dictated as the accounting method. And this is very important that this quantity, the DBO, is calculated every year at the current rate of high-quality long-term bonds, which we will call C. All right? So this is determined every year, and so if the bonds, if the bond markets, the rate goes down, of course our liabilities will go up, and vice versa. So we have this affection of the liabilities. Okay, then a proportion of the fund will be invested in the stock market, and another proportion would be invested in high quality bonds. In principle, if we determined the contributions, assuming that we will get the rate of return of high quality bonds, and I have 100% of the liabilities, and I invest them in these high quality bonds, everything else constant, that should be enough to cover liabilities. However, in reality, is that these pension plans assume, for funding purposes, a higher interest rate. So these plans assume that they can reach a higher interest rate, investing with some risk. So if I take that money and I only invest them in high quality bonds, money will not be enough, and the probability of ruin will be exactly 1. So I am somehow forced to take some risk, and here the question is, how much risk is optimum to take? So, and well, we are assuming here no shorts, so alpha, which is the amount invested in the stock market, is positive. And again, the main concern is the funding ratio, which we defined as the fund at time t divided by the defined benefit obligation at time t. And if the funding ratio is below a certain level, then the sponsor needs to take some action, which could be more contributions or reducing the benefits. And that's what nobody wants, right? Nobody wants to put more money, nobody wants to reduce benefits. So if we reach that threshold, that's where we call it the ruin of the plan. And it's not necessarily the ruin, it's not the end of the world, something will be made, but it's a bad situation. And I already explained that investing only in bonds is not feasible. That probability would be 0. Then I can incorporate this ruin theory, just what I explained. We say that the plan goes into ruin if at some time in the future, the funding ratio is less than beta, say 60%. So if funding ratio goes below 60%, something has to be done. We call that the probability, the ruin of the plan. And the probability of ruin is the probability of that happening sometime in the future for the life of all the members of the plan. So it is not exactly what we know as the Kramer-Lundberg situation for other uses of probability of ruin theory, but it takes the idea. And one thing, if we optimize in base on this, what is interesting compared to other ALM techniques is we don't need to make any assumption about the utility function of the sponsor. And in other cases, what we're maximizing the utility of the function the utility function of the sponsor based on what remains at the end of at the end of history, how much money is there, and we make some assumptions, which who knows. So here I'm not making any assumption about the utility function of the sponsor. And this is just an example. So we have an initial group of people who include retirees, actives. For sake of, simplicity, it's a closed group. But also it's because most defined benefit pension plans now are close to new members. So this is not as restrictive. So that's what I am using. And here the graphs reflect, the returns for the S&P 500, and here the return for the high quality bonds, right? And I'm starting just with this to make it easy. This is the probability of ruin will only be a function of alpha, the amount we invest in the stock market. Then I will show some other results with more assets. Just for sake of simplicity right now, it's just, and note that this is not a risk-free asset, right? Again, high-quality bonds do vary, and it's not, I'm not investing in short-term treasuries. So both are risky assets, but one has a lot to do with when interest rates go up, my portfolio, my investments will come down from the ones I'm investing in high-quality bonds, but so will the liabilities, right? Not necessarily with the stock market, right? And there, I use, to simulate the returns, I use a copula, again, because these are not independent. And there's not a clear dependency between interest rates and stock market prices. Theoretically, there should be, but again, in practice, it's not a clear dependency, but there is some kind of dependency, which we are capturing through a copula. I will not get into much details there. There are some more explanations on the article. I will skip this one here. So the general outline is I simulate the survivalship of the group until the last participant is alive. Then I simulate returns for the stock market and the bond market using this copula. And then every year, for different alphas, so for alpha, 10% of investments in the stock market on 20 or 30 or 40, right? For each of them, I calculate the resulting funding ratio, right? Of taking into account what is being paid to participants, the contributions, etc. And every year I calculate the funding ratio under different levels of investments in the stock market. Then I see which of these, for each of the simulations, how many went into ruin, and take the proportion as a probability. And here are the results. As I said, if I invest everything in bonds, it will not be enough because I am assuming from the beginning that I can invest at a high return. So if I invest at a lower return, it is certain that I will not have enough money. Then it starts dropping. It goes. It is indeed adding more risk if we take everything in the stock market. But well, and we have here at 70%, which is somehow consistent with what we see in reality, with what the market is indeed doing. Then I go to a double threshold model, which is, okay, why waiting until you reach 60%? So you reach, say, 65%, do something, right? And you could increase a little bit contributions, right? So I started with contributions at 4.9% of salaries, and I say, okay, if you are reaching ruin, if you are reaching 65% of funding ratio, increase contributions to 6%. So, and then continue, right? And it's not ruin until it goes down to 60. And of course, I mean, we have a lower probability of ruin, right? But at the expense of higher contributions. So it's obvious that we will have a lower probability of ruin if we are putting in more money at some point. And here, it's in terms of optimality, having 60 or anything between 60 and 80% in stocks is optimal from this point of view. Okay, then we have something even more realistic. So this is a dynamic contributions model, which means I will be doing contributions depending on the funding ratio. So I don't wait until it gets till 65, but if it's, I have this formula here. So the contributions will be the maximum between 4.5% or 3% plus 7%, 1 minus the funding ratio, so which gives something in average the same contribution as the ones I was using without moving them. So this is not at the expense of more contributions necessarily, but it is dynamic. So if my funding ratio is going down, I start contributing more. If it's going up, I may go down from 4.9 that we started to 4.5% of contributions. So yes, we have a lower probability of ruin. Probably because in those scenarios we're doing a bit more contributions, but it does not go suddenly from 4.9 to 6%. It does it little by little. So, and this is what in reality companies do more or less. And again, I mean, and what is interesting is that again, it's about 70%. So in terms of calculating the optimal asset allocation, different models end up giving more or less the same results. Okay, and then we go to several asset classes. So here we bring up some of the portfolio theory from Markowitz, and what we calculate is the efficient frontier, and we do simulations. Remember, previously simulations were done with 0, 10, 20, 30, etc. % of investments in different assets. Here, doing this with several assets would be, I mean, a very big matrix of investments. But here, what I do is I calculate the efficient frontier, and I take different portfolios along the efficient frontier, and that is what I simulate. So I simulate 4 portfolios on the efficient frontier. Now, we could say, okay, would the optimal fall on the efficient frontier? And I'm sure that under certain assumptions, we could prove, and certain conditions, we could even prove that yes, indeed, that should be the case. Now, in reality, and without putting constraints, it may be the case that we have, in terms of ruin probability, of minimizing ruin probability, we could have a portfolio that is not on the efficient frontier, and that we would be missing. So we also did some, I would say, some random tests close to the investment frontier to see if that would be the case. And then here I show different indications. I mean, the minimum ruin probability, the maximum Sharpe ratio, the mean variance, a random, etc. Or a naive portfolio. A naive portfolio is 25% on each case, and here I compute the probability of ruin. And here I have how much should be invested in which things. And here, I mean, these results give, okay, 35% should be invested in gold. I'm not sure if that should be a sensible idea, but I mean, the model tells us at least what historically it has been the case. I mean, copulus, for the copulus models, I use as marginals the empirical distribution of each asset. So what this tells us is, I mean, at least on the past 20 years, it would have been sensible in order to minimize the ruin probability of a portfolio to invest a large amount in gold. So, I mean, here to compare somehow with the original model, again, not surprisingly, including more assets allows us to have an even lower probability of ruin, which again is consistent with all the economic theory. So these are the results, and we'll be very happy to take on your questions.
We're in a relatively small room, so if anybody has not submitted their question through the Join app, if you raise your hand, we'll bring a microphone to you. Gentleman at the front.
Just had a quick question. When you were doing the Markowitz-based mean variance optimization, what assumption did you make for the correlation between the asset class returns? What period did you look at? Did you look at multiple periods or?
It was 20 years. It's a 20-year historical returns. I look at the annual returns as the variable, and what I use are copula. So I find the copula that best fits the. I don't assume a specific correlation, but the copulas. Of course, there's some correlation in between there. So yes, there is whatever is the best fit for the data.
Thank you. Very interesting. What about mortality? What kind of mortality have you used there?
In this case, since this is not the core of what I'm trying to show, I mean, what I'm willing to show is this methodology, avoiding utility functions, etc. So for the purpose of this paper, I'm just using a deterministic mortality, and I just simulate the group until extinction without stochastic mortality or whatever. It could be, I mean, easily incorporated. I just didn't want to turn the focus of of the investigation into that. But yes, certainly on a more realistic model, we should be taking some stochastic models for projecting mortality as well. It will just bring, I mean, a bit more noise. I would assume that mortality is not correlated with the assets. So. Who knows? And I have seen some presentations that, I mean, not mortality per se, but demography does produce certain, I mean, has some correlation with economic growth and thus with stock market returns, et cetera, et cetera. So at the end, yes, mortality could be correlated as well.
Hello. The thing of the dynamic contribution, when you consider the change on the contribution, I was wondering if you could also do something similar, but with the age of retirement, like change it, because it would be interesting, because recently in many countries, for instance, in France, they changed like the age of retirement and has... Yes, of course. I mean,
that could be one case, as I explained. The problem when reaching a certain threshold is you have two things. Either you increase contributions or you reduce benefits, which increasing the retirement age it's a way of reducing benefits. And yes, of course, it could be done like in parallel. Okay, so the company is doing more contributions, and the employees will be retiring a little bit later. So yes, that could be incorporated into the model. I don't know how easily that could be incorporated in negotiations with the employees, but and if it's their contributions, if they're contributing to the plan, that might be easier to say, okay, how much you want to contribute more against how much you want to delay retirement in order to avoid ruin at any cost, and then we go into what we call these defined ambition plans or target benefit plans. So yes, could be incorporated as well. It's a good idea to. I need to put more things for to presenting.
So, Abe, your definition of ruin is one of the components was if the ratio of assets to liabilities fell below 60%. I work in the United States in pension areas, and that is the rule. If the plan falls below 60%, the plan has to be frozen. So you wouldn't have any additional accrual even for the current employees. So it has some reality.
Yes, it's based on that. Yeah.
I have a question.
Sorry, you mentioned that you used 20 years of data to calibrate your model. If you chose specific points in time for that data, like say if you and you excluded say the 2008, 2009 GFC period, did you get different answers in your?
Yes, certainly. I mean, I didn't do it, but certainly I've done it for some other things, and you can talk. When you're talking this with the sponsor, you can say, okay, which kind of scenario do you think is more realistic for the future? You can take the historical. We can exclude this. We can concentrate on this period, etc. And yes, of course, you have different results for asset allocation, certainly. And nobody knows the future, so I cannot say which one should be the best to do.
Hi, good afternoon. Thanks for your presentation. That was quite interesting. I've got two questions. The first one is, did you look at the inflation risk into those pension plans and the interaction between inflation and equity returns and interest rate?
So, sorry, I didn't mention it. Yes, I did. One of the variables is inflation. It goes into the copula, and yes, it is taken into account. And of course, salaries increase within a bit more above inflation. Contributions thus are affected by inflation, and of course, payments. I am assuming that pensions are indexed to inflation. So yes, and it is that dynamic of inflation with the other assets. It's considered.
Okay, thank you. And the second question is regarding the duration, the ALM mismatch between the duration of the assets and the duration of the liabilities. What assumptions did you take through the modeling? Did you keep the duration close to zero? Is there any, because obviously when you're moving the alpha, then there's an impact on the duration of the fixed income assets. So
yes, well, I keep for the investments in high quality bonds, I assume a fixed duration for that portfolio. I don't remember exactly if it was 15 years or something like that. So, and it could be something related. I mean, it could be a fixed duration related to the duration of the liabilities.
okay, thank you.